Hi everyone. We are kicking off chapter 7 here, looking at plant assets, natural resources, and intangibles. So last chapter we did inventory, which is kind of the last current asset on the balance sheet that we're going to talk about. And now we're moving into long-term assets on the balance sheet. This is a fairly lengthy chapter, so there's 8 learning objectives that we want to accomplish here, explaining how to account for the cost of plant assets. So how do we come up? Remember the historical cost principle, but there's a little bit more to that. Figure out what exactly is a capital expenditure versus an immediate expense. Explain how to account for depreciation. Analyze the effect of a plant asset disposal. So when we sell it or get rid of it, how do we account for that? Look at how we would apply generally accepted accounting principles for natural resources, things like timber or oil in the ground, and intangible assets. Intangible assets just means things you can't touch. So tangible would be things I can touch, like a desk or pens. Intangible are things like patents and contracts and brand names and whatever the case may be. What happens around asset impairment? So if you have an asset that something happens where it's impaired, meaning the value of it takes a hit, how do we account for that? And what the rate, analyze the rate of return on assets. And also we're going to start looking more and more at the statement of cash flows. We'll build up to it towards the end of the semester, but here we'll look at how cash flow gets impacted with long-lived asset transactions. Main idea here is we have on our balance sheet an asset account, plant assets. So things like land, buildings, machinery and equipment, furniture and fixtures, and land improvements, right? So land, think of it like the raw land. Land improvements are things we put on top of the land. So fences, lights, pavement, right? If we create a parking lot and we have pavement, things like that. We also then have these natural resources on the balance sheet and intangible assets, things like patents, right? That's probably the one you'll see the most often, especially if you work in the Bay Area. Then we have the income statement part of this whole exercise, which is really depreciation expense for any of these things. Nothing for land, right? Land does not get depreciated. But you'll have depreciation expense for buildings, plant, and equipment, furniture, and fixtures. For natural resources, we call it depletion expense, right? And that will go through cost of goods sold, and we'll see that in an example what that means. And for intangible assets, amortization expense. So how do we account for plant assets? Here's the key word, and this is a little bit of a repeat from inventory. Just remember that when you're measuring the cost of an asset, it's the sum of all costs incurred to bring the asset to its intended use. So the purchase price, taxes, commissions, other costs that make it ready to use, right? So training employees to use it the first time, building a special sitting area for this piece of equipment, let's say. So if you're buying land, here are some common costs when you buy land. You have to pay whatever the land costs. You sometimes also have to pay a broker a commission. You might have to have this land surveyed, so you'll pay some survey fees. You might have some attorneys that you need to pay in order to do the contract and all the paperwork. Maybe somebody didn't pay property taxes on this piece of land and you have to pay them before you can actually take ownership of the land, right? You might have to grade or clear the land. If the land has some junk on it that you don't need, you need to get it ready or back to raw land. You might have to remove any buildings that you don't want. You might just want the land and it has some old rickety buildings or whatever you have to remove. All of this is going to go into the cost of the land. So here's a good example. FedEx signs a $300,000 note payable that buys 20 acres of land. In this transaction, FedEx will also pay $10,000 of cash for a real estate commission, $8,000 of cash for back property taxes, $5,000 of cash to remove an old building, and $1,000 of cash as a survey fee. They will also pay $260,000 to pave the parking land, well, to pave the parking lot, and all of that is in cash, right? So what is FedEx cost of this land? Well, it is the original purchase price of $300,000, the real estate commission, the back property tax, the removal of the building, the survey fee. Even though those were paid separately in cash, that is still in the cost of the land. So you might ask, why is this amount not in there? Well, a parking lot is a separate asset. That is a land improvement. That would take a separate part of the balance sheet, and a parking lot we would actually depreciate, right? So even though it is connected to the land, it is a separate asset called a land improvement, a land improvement. So here's the journal entry for this transaction. We're going to debit the land account for that $324,000. The way we paid for all of this was we paid $300,000 with a note payable, and we paid the $24,000 of all those fees in cash. And to be sure, just to avoid confusion, this $260,000, they don't show the journal entry, but it would be another journal entry. So it would be parking lot, $260,000, cash, $260,000, right? That is a separate journal entry. They don't show it here. Let's look at building machinery and equipment. When you're constructing a building, if you're building a building, right, you're going to pay architectural fees, you'll do building permits, there's contractor charges, you'll have material, labor, and overhead. You'll also pay interest on money borrowed to finance the construction. All of this, by the way, is going to be part of the cost of a building. What if you purchase the building instead? Well, you have a purchase price, brokerage commission, sales and other taxes, and expenditures to repair and renovate building for its intended purpose. One difference here is that when we build a building, if we're borrowing money to finance construction, that's part of the cost of the building. But if we're buying the building, then the interest to buy the building is not included. It's a separate period cost. What about the cost of equipment? Well, we have the purchase price, less any discounts we might receive, right? For example, if we pay early, any transportation from the seller, insurance while it's being transported, any sales and other taxes, any commissions that we needed to pay to buy it, installation costs, right? Any money we have to spend to test the asset before it's placed in service, right? This also includes training employees to use this asset early on, not after it's already been put into service. All of this is before it's been put into service. That's the key, before it's been put into service. Maybe a special platform needs to be constructed to hold this piece of equipment. That would also go into the cost. All of this would go into the cost of the equipment. Land improvements and also leasehold improvements. If you lease a building, meaning you're renting it, and you do some improvements to that building, well, technically they're not yours, because when your lease is up, you give back the building. It's pretty unusual that you're going to take the improvements that you made. So those are called leasehold improvements. So here's some examples of land improvements. Things like driveways, signs, fences, sprinkler systems, other items. So this is not land. These are separate assets. They are land improvements. And then some leasehold improvements. Again, this is just improvements made to leased or rented property. You're going to depreciate or amortize these leasehold improvements over the lease term, right? Because theoretically, once the lease term is over, you leave those assets behind with the building when you give it back to the owner. This is very common, right? Oftentimes when you buy, let's say, a building, you're buying several assets with a single lump sum amount. For those of you, if you think about it, if you're buying a house, many of you probably haven't purchased a house yet, but if you buy it, you're buying the land that the house sits on plus the house. So what we need to do is divide the total cost among the different assets, and we'll do that based on relative market values. So this is a technique. The name is relative sales value method. Let's look at an example. So FedEx purchases land and a building, so together, land and a building in Denver. The building sits on 2 acres of land. The combined purchase price is $2.8 million. You do an appraisal. The appraisal indicates that the land's market value is $300,000 and that the building's market value is $2.7 million. We do not put $3 million in our books, right? We don't use these numbers because we have to do historical cost. But what we can do is do the relative value. So the land is $300,000 of value, of appraised value of $3 million, or 10% of the market value. The building was appraised at 2.7 of the 3 million total appraisal. So the relative value is 90%. Then we can apply these percentages that we found to what we actually paid. And that's how we can divide up the cost, the paid cost, the historical cost of 2.8 million between the land, 280,000, and the building, 2,520,000. So again, you're not going to put this 3 million on there. You're still accounting for the 2.8 million purchase, but that's how you'll break up the cost. And so you see the actual journal entry, you're debiting land for 280,000, you're debiting building for 2,520,000, crediting cash for 2.8 million. Okay, let's talk about when is something a capital expenditure and when do we just immediately expense it? So capital expenditures increase the asset's capacity or extend the useful life. So for something to be capitalized, that means that the cost becomes an asset account rather than being expensed immediately. So this is the exact example of purchasing a car, right? If you purchase a car, you don't expense car expense. You debit car, let's say for 1,000, and you credit cash for 1,000. So you've debited an asset account. So this is capitalizing something, right? The cost of the car versus an expense like rent expense and cash. Here we have an expense account. This is an immediate, we're expensing immediately. So here are some examples of when we would record an asset instead of an expense. So if we do a major engine overhaul for a car, right? If we modify the body of a car or truck for new use, if we add additional storage capacity, all of these would be an example of, for example, an asset. So we might do something like new engine debit 2,000, cash 2,000. So you see, we replaced the engine in the car or the truck, but we created an asset account that we will then depreciate over time. What would be an example of a car expense where we would immediately expense it? Things, any ordinary repairs, right? Repairing the transmission, an oil change, replacing tires or a windshield or getting a paint job or something like that. Generally, these will not extend the life or capacity of an asset. So here we might just do, whatever the case may be. I'm just making it up here, but let's call it oil change expense, $30, cash, $30, right? So we would just expense it right away. This would not be an asset. So that's the difference. Now let's talk about depreciation. First keyword, we've already introduced this in this class, but really important that we hit it again because it's a very important concept. When we talk about plant assets, we're going to record them on the balance sheet at book value. Book value is just your historical cost less the accumulated depreciation for that asset. What is depreciation? It's the process of allocating a plant's asset cost to expense over its life, right? We started as an asset and we're allocating it to the expense. It's necessary because plant assets will wear out, they grow obsolete, they lose value over time. This also allocates the cost against revenue it helps to earn each period, the matching principle. Depreciation expense shows up on the income statement, and very important, land is not depreciated, okay? Land does not get depreciated. So let's look at an example. Here, an airline buys a Boeing 737 for $32 million. It's estimated that this airplane will last for 20 years. So if we were to do just, here this diagram just shows the matching principle. So it's showing you each year we're generating around $9 million of revenue for this asset, and we're taking an expense of $1.6 million each year against this purchase price. And the way we did this with straight line depreciation, we just took our purchase price of $32 million, we assumed there's no value at the end, we divided by 20 years, so we'll take an expense of $1.6 million each year. So some more terminology before we start diving into depreciation methods. So the cost was the purchase price and all costs to get the asset ready for use. We just did that earlier in the lecture. The estimated useful life, what is the length of service that you expect from this asset? It's an estimated amount. An estimated residual value, what is the expected cash value at the end of its useful life? If anything, might be zero, there might still be some value at the very end. So just like we had different methods for accounting for inventory, we have different methods for doing depreciation. The straight line method, units of production, double declining balance method. Honestly, the best way to look at these and learn them is just to look at some examples. So we're gonna use this data. We have a truck that we purchased for $41,000. We estimate that at the end of its useful life, we can junk this truck and get $1,000 for it from some scrap yard or whatever the case may be. So we're going to get $1,000. That means we're able to depreciate the difference, the $40,000, right? The difference between what our historical cost was less the residual value. One estimate is that this truck will last 5 years in our business. The other estimate is that it will run for 100,000 miles before it reaches the end of its useful life, right? So in this case, our units are going to be miles. These units can be whatever you want them to be, whatever makes sense. But for a car or truck, miles is usually a good example of units. For a piece of machinery, it might be hours or something like that, hours of usage. So straight line method is the most straightforward. It just takes an equal amount of depreciation each period, okay? You take the depreciable cost, which is, in our example, the 41,000 less 1,000 equals 40,000. So that is our depreciable cost in our example, 40,000, divided by the useful life, 5 years or 100,000 miles, to determine an annual depreciation expense. So here you go, straight line, the cost, 41,000, less the residual value, 1,000, divided by the number of years. Here's the equation for straight line depreciation. Cost minus residual value divided by useful life in years. So in this case, we're gonna take $8,000 per year. So each year, here's our depreciation expense for the truck. Depreciation expense truck, 8,000, accumulated depreciation, 8,000. So we'll do this each year for 5 years. And here you go, this just breaks it out. We bought the truck at the beginning of 2015, right? It cost us 41,000. We're gonna depreciate 40,000 of it. The book value, remember, what is book value? It's our historic cost minus accumulated depreciation. Here it's 0, so this is just 41,000 minus 0. After 1 year, we're going to expense 8,000, so our accumulated depreciation is 8,000. Our book value drops to 33,000. The next year, 8,000, straight line method, accumulated depreciation is now 16,000, the old 8,000 plus the new 8,000. Book value is now 25,000. Look through this, let it kind of sink in, make sure you feel comfortable with all of these different columns and how straight line depreciation works. Next method, units of production. So we still have a fixed amount of depreciation that gets assigned to each unit of output produced by the asset. The depreciable cost, okay, again, $40,000 in our example, gets divided by useful life, but now instead of years, we're going to use units of production, and that's going to determine our amount per unit. Okay, so then we get a per unit amount and multiply that times the number of units produced each period to figure out what our depreciation expense is going to be. Again, easiest you see an example. So same exact data. We have cost minus residual value, so that still gives us our 40,000. And now we're going to divide it by useful life, but we're going to have units of production instead of years, like we did in straight line. So you see it's 40,000 divided by 100,000 miles. So our depreciation is 40 cents per mile. So what do? We look at that same exact table, except now the way we calculate it is at the end of this year, we're going to say how many miles did we actually use this truck? 20,000 miles, right? How much are we depreciating per mile? 40 cents. Where did this come from? Right there. So our expense for this year is 8,000. So accumulated depreciation is 8,000, book value is 33,000. It's just coincidence that this matches the same as straight line method, right? Let's look at next year. Next year we use this truck for 30,000 miles, same 40 cents per mile. We have our yearly expense of 12,000. That gets us our annual depreciation of 20,000. Okay, that's the 8,000 here plus the 12,000 here gets us 20,000, and book value of 21,000. The original 41,000 minus accumulated depreciation of 20,000 is 21,000, and on and on. Again, study this. Make sure you feel comfortable with units of production. Now we have double declining balance method. This one makes a lot of sense for assets that depreciate really fast early on in their life, right? So you're going to write off a larger amount of the cost near the start of the asset's useful life. This is the most frequently used accelerated depreciation method. This is double declining balance, but there's like 1.5 times declining balance and other methods, but this one is the most frequently used one. It's why we're learning it. What you're going to do is you're going to multiply the asset's declining book value at the beginning of the year by a constant percentage. That percentage is 2 times the straight line depreciation rate. Again, examples will save you here. So let's look. Same exact information. We're still depreciating that 40,000, all the same info. So how does double declining balance work? Well, we're going to take the number 1, divided by the useful life in years. This is back to straight line method, 5 years, and we're going to multiply it times 2. That's where the double comes in. So 1 over 5 years times this equals 20% times 2 equals 40%, right? 20% times 2, 40%. So how does that 40% get used? Well, we're going to have our book value. So this is a little bit different. Before, when we were doing depreciation with straight line method or with units of production, we were depreciating based on $40,000 worth of depreciable cost. We still consider that, but with double declining balance, it's a little bit of a different method, okay? What we do is we start with the full purchase price, $41,000, and our double declining rate, 0.4. This is just coincidence that it matches the units of production 40 cents per mile. This is 40% here that we're referring to. We're going to take 40% times this previous year, 41,000. That's going to give us our yearly expense. So accumulated depreciation, book value, same math as before. Now for this next year, we're going to take 40%. We're going to multiply it times this 24,600. That math gets us 9,840, and that is our expense for this year. And then accumulated depreciation gets added, and we go on and on. Here's the big difference. You see this little asterisk? So the final year depreciation is a plug amount needed to reduce the asset book value to the estimated salvage value. So here's where that residual or salvage value comes into play, that 1,000. This final year this final year, the math that you're going to do is 40%. Normally, the math that you're going to do is 40% times the previous year, right? But if you do this math, you'll see that it comes out to some number around 2,000. We don't do that. This final year, we ignore this math and simply compare what our last year value is to what our residual value should be, and take the difference between these two, which is equal to 4,314. Work through this problem a couple times in this slide. Make sure it clicks because it's a little bit different than the other two. We don't worry about the 1,000 residual value here. We take it into consideration at the end. So two big differences for double declining method, right? The residual value gets ignored at the beginning, only at the beginning. And then the final year depreciation is just a plug. We're just plugging the difference. We're just figuring out what number do we need here in order to bring this down to the residual value, to the 1,000. So the final year depreciation is just a math equation of one number minus another number. So let's compare these methods, okay? So straight line, usually good for plant assets that generate revenue evenly over time. Units of production, assets that wear out because based on use. Double declining balance, assets that generate more revenue earlier in their useful life, right? Think of software. Software usually loses its value very quickly, or it's the most valuable right when it comes out, and then eventually there's better software, or competitors come out with other stuff. This is really key, this comparison, for a couple of reasons. One, it lets you compare how the yearly expense varies based on the method you use. But the most important aha moment that you should realize is, again, accounting does not create or take away numbers. It simply takes figures that have already happened and asks, how do you want to show this? So at the end of the day, no matter which method you choose, you are only depreciating the $40,000 of depreciable cost. No more, no less, right? It's just how are we showing it here based on which method we use. Here's a graphic representation of the different straight line units of production, accelerated double declining balance. The nice thing is most companies, most large companies are going to use straight line, right? Some will use accelerated, some will use some other method, some will use units of production. But the vast majority will use straight line. So let's look at some other issues when we talk about plant assets, right? There's some complexity here because we get long lives, right? Depreciation will affect income taxes, so that's a big deal. Just like choosing your inventory method in Chapter 6 affected your income taxes, so does depreciation. And companies may end up with gains or losses when they sell plant assets. Shortly here, we'll talk about what it looks like when you buy or sell a plant asset, when you sell or dispose of a plant asset. So let's look at depreciation for tax purposes. So for financial reporting, most companies will use straight line depreciation, but for tax reporting, most companies will use double declining balance. Okay, they prefer accelerated depreciation because you get the fastest tax deduction. Tax deductions reduce your current income taxes, and income taxes, which you have to pay in cash, help you to conserve cash, right? So the IRS is fine with this, but if you look here as an example, the same revenue, the same cash operating expenses. So before we do income tax or depreciation, we have $100,000 under both methods. If we use straight line depreciation, then you see our income before tax is $92,000. If we pay a 30% tax rate, that's our tax bill. If instead we use accelerated depreciation, then our income before income tax is lower. Our income taxes this year are lower. This is called a temporary difference. It works itself out. If you never buy another plant asset, obviously this will work itself out because in future years, this will be higher. This will be the 8,000 still, but this will end up being lower than 8,000. If you don't recall, look back on each year how much the accelerated method was. But for this year, we're gonna have operations, cash provided from operations of 100,000. Now we have to pay income tax. Under this method, we pay this much in income tax. Under accelerated method, we pay this much in tax. So our net cash provided by operations, here and here, becomes, you can see the difference, right? By using the double declining balance, we have an extra $2,520 of cash. So this is why we would prefer to have this for tax, and this is fine for our regular financial books. And again, this is legal and even encouraged by the IRS. Why? Because the IRS wants you economically to buy new assets all the time. It helps the economy. So here are some modified accelerated cost recovery system called makers. So you will hear this, especially if you start dealing with taxes. So the IRS has provided actual rules of things like race horses, you get a asset life of 3 years, automobiles, light trucks, 5 years, and different things, right? So very interesting. For example, they have specific sewage treatment plants are good for 15 years, and the method that's supposed to be used is 150% double declining balance. So the one we've learned so far is 200%, right? 2 times. This one is 1.5 times. What happens if we have partial years, right? So what if FedEx purchases a warehouse building on September 1st for $500,000? The useful life is 20 years, residual value is 80,000, right? We're just going to do straight line here. So 500,000 minus 80,000 residual divided by 20 years, that's 21,000 per year. But we purchased this September 1st, right? So we're going to do partial depreciation. And our partial depreciation is going to be here 21,000 times 9 out of 12. And this is for year-end May 31st. So for 9 out of 12, if you have a question of how did we get 9 out of 12? Well, September 1st to May 31st equals 9 months out of 12 months in a year. Sometimes what happens is you have a change in the useful life based on some new information. So this would be called a change in accounting estimate. You estimated the useful life, but now you're changing that estimate. So here's an example. If Disney buys a hot dog stand for $50,000 and assumed that there was 10 years of life in that hot dog stand, no residual value. Once it's used up, they throw it in the garbage. Disney uses the asset for 4 years, so accumulated depreciation is 20,000. How is it 20,000? Well, 50,000 minus 0 divided by 10 equals 5,000 per year times 4 years equals 20,000. So you have a remaining book value of 30,000, right? The difference between 50,000 and 20,000 is the 30,000 left over. Now management says, actually, I think we can still get another 10 years out of this hot dog cart, right? So 4 years has passed and we can get another 10 years out of it. So what would we do now? We would just take the remaining depreciable book value, 30,000, the new estimated years, 10 years, and create a new annual depreciation of 3,000. So we would just do that moving forward. We wouldn't go back in time and change all the financial statements. We would just adjust moving forward. At some point, you fully depreciate assets, right? So the asset has reached the end of its estimated useful life. Here's the key. You don't have to get rid of it. You can still use the asset. You just can't record any more depreciation, okay? When you get rid of the asset, you need to get it off of your books, right? So when you get rid of it, you're going to need to remove the asset cost and accumulated depreciation. Even though book value is 0, you still have this equipment on your books and you still have the accumulated depreciation. So if we were to get rid of it, like throw it in the garbage, right? There's no residual value. We fully depreciated it. We need to just get rid of it. Well, all you're going to do is debit accumulated depreciation for the equipment, 60,000. You're going to credit the equipment for 60,000. You're just going to get rid of it. So let's look at that here. So before we dispose of the asset, we need to bring the depreciation up to date, right? Meaning we need to run depreciation and make sure we've run depreciation up to this moment when we're gonna get rid of it. That way we get the asset's final book value and we can record the depreciation expense up to the date of the disposal. In this example, this was what we just went through where we've already fully depreciated this asset. So fully depreciated asset, right? So we finished it off. 60,000 was what it cost us. There's no residual value. We're just writing it off. So we're debiting accumulated depreciation machinery for 60,000 and we're crediting machinery for 60,000. This disposes of a fully depreciated machine. What happens if it's not fully depreciated? Suppose that the equipment costs 60,000 and there's 50,000 of accumulated depreciation, meaning a book value of 10,000, right? 60,000 minus 50,000 equals 10,000. And so now we dispose of it, okay? So we just get rid of it. Whatever happened, the equipment there's no proceeds, right? We're not selling it, we're just junking it. We're just disposing of the equipment. Well, we're gonna zero out accumulated depreciation for this piece of equipment. We're gonna get this equipment off of our books. The difference here is gonna be a loss on disposal. This is an important, it's like an expense account, but different, right? It's a loss account. It's an important account to kind of think about or remember because when we do the statement of cash flows, understand that in this step, there's no cash here at all that's happening, right? So this loss is just a paper loss because we've written this asset down to only 50,000 and we need to get the entire asset off of our books, which cost us 60,000. So the difference is going to be this loss. Let's talk about selling a plant asset now. So if FedEx sells equipment on September 30th, 2018 for $7,300 cash, the equipment cost $10,000 when it was purchased, has been depreciated using straight line, estimated life of 10 years, no residual value. Okay, so 10,000, no residual value, 10 years, that gives me $1,000 per year. FedEx sold the equipment on September 30th. That's 9 months in the year. So the first thing I need to do is bring up depreciation expense. So this is September 30th, 9 months out of the year. I do 1,000 per year. So 1,000 times 9 over 12 gives me 750. And that's my accumulated depreciation. So this is updating depreciation, bringing it up to date. So if we look at this, we bought it on January 1st, 2015. So how does the T account work here? Well, 2015, we took depreciation of 1,000, 2016, 1,000, 2017, 1,000, and now we got rid of it on September 30th, 2018. So we partially depreciated up to the date of disposal. So we've depreciated 3,750. We originally paid 10,000. Our book value, therefore, is 6,250. 10,000 minus accumulated depreciation of 3,750. We sold this asset for 7,300, right? Again, it cost us 10,000. We had accumulated depreciation of 3,750. Our book value is 6,250. Therefore, we sold it for $1,050 more, right? Look at this book value plus $1,050. That's what we sold it for. So this $1,050 difference would be a gain on sale of the asset. Again, this isn't the cash that came into the firm is this $7,300. This is just an accounting issue, right, that we're dealing with. That's a really important, what I just said is important for when we look at the statement of cash flows. So just remember that. So let's look at selling a plant asset. Suppose FedEx sells equipment September 30th for $7,300 cash, all the same exact details, right? What is the journal entry now for this example that we just did to sell it? Well, we got cash of $7,300. We have to write off accumulated depreciation. We have to write off the equipment at our historical cost. As you can see, this adds up to $11,050. This only adds up to 10,000, so the plug is our gain on sale of equipment. What if we exchange a plant assets? What if we trade in an old asset for a new one, like a non-monetary exchange, one item for another item? So we're going to base it on the fair value of the assets being involved, and any differences between the fair values of the old and new assets give us a gain or a loss. So let's look at the pizza place Papa John's. Assume they have an old delivery car. It costs $9,000. We've depreciated $8,000 of it. So the book value on this car is how much? Book value? $1,000, right? That's what's left. Now, Papa John's trades in this delivery car for a new one. The fair market value of the new truck is $15,000, and they have to pay $10,000 in cash. So let's take this journal entry and break it down step by step. So first, they pay $10,000 in cash. I always like to start with cash because that's the clearest account to me. So cash went down by $10,000. We're going to credit cash $10,000. Okay. We've gotten rid of the old delivery car, which cost us $9,000. We have to write this off of our books. So we're going to credit the old delivery car for $9,000. We now acquired a new asset, a delivery truck or car, that's worth $15,000. So we have to add this new asset of $15,000 new car onto our books. Since we got rid of the old car, we also have to get rid of the accumulated depreciation that's associated with that old car, right? We have to get rid of that. Accumulated depreciation is normally a credit balance because it's a contra asset account. So we're going to debit it for its balance of $8,000 to get rid of it. So when all is said and done here, we have debits of $23,000 and we have credits of $19,000. What's the plug? Well, it's the gain or loss. In this case, it's a gain of $4,000 because we need to credit $4,000 in order to make our credits equal to $23,000. So that's my approach to a problem like this. It's a big journal entry with a lot of accounts, but if you just take it step by step, it's definitely doable. And the transaction here is trading in an old delivery car for a new one. So here's how you would analyze T accounts for plant asset transactions, right? If you look at a building or equipment account, you'll have a beginning balance. The cost, because that's how you account for buying buildings or equipment, the cost of what you buy, that should give you your ending balance. But you also dispose of some assets, right? The cost of the assets that you disposed of would be on the credit side. So if you need a plug for one of these numbers, these are the different components. What happens for cash when it comes to plant asset transactions? Well, if you dispose of if you dispose of property, plant, and equipment, that means cash comes in. If you buy property, plant, or equipment, cash usually goes out, right? Unless you buy it with something like accounts payable. But again, we're dealing with the cash account here. Depreciation expense, well, for the current period, you need to calculate depreciation expense. That's a debit. It's an expense account, just like rent expense. Accumulated depreciation, a contra asset account. So we work on, even though it's an asset account, it's a contra asset account. So we're working on the credit side. We have our beginning balance, any additional depreciation expense for the current period, right? And then the ending balance. Because whenever we have depreciation expense for the current period, we're going to credit accumulated depreciation, right? So that's where this credit comes in. And when we dispose of assets, we're going to debit accumulated depreciation. That's going to decrease our depreciation, the accumulated depreciation amount. So take a look at that one. Long-term debt, when we take on new debt for assets, well, this is a liability. So on the credit side, we're going to add long-term debt. If we have a gain on sale of a building, that's on the credit side. You can think this is not a revenue, it's different. A revenue and a gain are two different things, but you can think of it the same way. Just like a loss is different than an expense, but it's accounted for in really the same way. So here, let's look at some buildings that as an example for this analysis, right? So you have some buildings that cost 100,000. You bought another building for 150,000. So how much should you have in ending balance here? 250,000, right? But you don't. You have 180,000. So what must have happened? Well, I must have sold $70,000 worth of old assets, right? The costs of old assets. So I didn't sell it for $70,000. I don't know what I sold it for. That was my historical cost. I'm writing it off my books, 70,000 worth. Let's look at generally accepted accounting principles for natural resources and intangible assets. So natural resources, you can think of like iron ore, oil, timber, right? What we use here is depletion. Very similar to depreciation, but there are a couple key differences. Because here what we're doing is tracking the flow of a natural resource from its raw state through inventory to cost of goods sold. Let's do an example. So if ExxonMobil buys an oil field, oil reserve for $100 million, and their engineers estimate that there are 10 million barrels of oil in there, right? So first, what's the journal entry? Very straightforward. They bought an asset, oil reserve, they paid cash for it. Debit asset, 100 million. We assume all the costs are included in there. Credit cash, 100 million. The depletion rate is $10 per barrel. How did they get $10 per barrel? Well, if we have 100 million that we paid, and we estimate there to be 10 million barrels, that gives us $10 per barrel. Just like straight line depreciation, right? Very similar. There's just no residual value here. So that's how we got $10 per barrel. So if we take out 3 million barrels during this period and we sell 1 million of them, how does this look with journal entries? Well, we took out 3 million barrels at a cost of $10 per barrel. So we're adding to our inventory 30 million, and we're reducing our oil reserve by 30 million. This is one big difference between depreciation. Remember in depreciation, we had this accumulated depreciation account, right? We didn't directly hit the asset. Well, here we're not gonna have that. We're just gonna directly take 30 million out of this asset oil reserve. Then when we sell 1 million barrels, they each cost us $10. So we're gonna have a cost of goods sold. They call it cost of oil sold. This is just a cost of goods sold account, debited for 10 million, and reduce oil inventory of 10 million. So we basically sold 1/3 of this, right? We put 3 million of barrels into inventory, and we sold 1 million of those. So just to be sure, so that doesn't avoid confusion, we did not put in the journal entry for how much we sold it for. They didn't tell us how much we sold this for, so we do not have a sales revenue journal entry. Obviously, we will have one that was just outside the scope of this example. So accounting for intangible assets, things that we can't touch, right? They're long-term assets that have no physical form. Patents, copyrights, trademarks, franchises, leaseholds, and goodwill. We'll touch a little bit on what goodwill means. There's two categories of these intangible assets. Ones that have finite lives, meaning a set amount of, we know what the life of it. Patent is a good example because a patent usually has a legal time period. Like you have this patent for 20 years. Then we do amortization. But there's some assets that have indefinite lives, right? Think of a copyright or a trademark, right? What is the life of the trademark Google? Pretty much forever. So those types of assets, we're gonna check annually for any impairment, and we'll only write them down if there's an impairment charge. So let's look at patents as an example, right? They get granted by the federal government. The holder of a patent has the exclusive, there should be an L here, exclusive right to produce and sell this invention. They usually last for 20 years. So if Sony pays $170,000, they're going to acquire a patent on January 1st. They believe that the patent only has a useful life of 5 years. Again, even if the government gives you 20 years, if it's a technology that's going to be out of date in 5 years, you need to depreciate it or deplete it over 5 years, right? So what do we do here? When they bought it, They bought the patent, debited for 170,000, credited cash. That was buying the patent, right? Asset, asset. Just switching one asset for another. At the end of the year, we're going to do an amortization expense. And again, here we don't do accumulated amortization like we did in depreciation, right? We don't do that. We're just going to directly hit the asset. So we're debiting amortization expense, 170,000 divided by our 5-year useful life, $34,000 per year, and then writing down patents directly by 34,000. Copyrights are another good example. They're granted by the federal government. These give the holder, again, this should be with an L, exclusive rights to reproduce and sell a book, a musical composition, a film, or some other work of art. A copyright generally extends 70 years beyond the author's life. So once the author dies, there's another 70 years that their estate can utilize that form of art. Then some more examples, trademarks and trade names, right? Distinctive identifications. Think of the Tesla symbol the T symbol on a car, right? So the useful life may be set by a contract, then you would just amortize it over the useful life. It might have an indefinite life and not be amortized. Think of the Google logo, right? Or the Google name. So that's something that doesn't really have a set life. Google was probably going to be around way longer than any of us are alive. What about franchises and licenses? So this gets granted by either a private business or a government, gives you the right to sell a product or a service in accordance with some specific conditions. Think of a franchise for a McDonald's, right? So restaurant chains like McDonald's, sports organizations, these generally have indefinite lives. When I pay upfront maybe $1 million for a McDonald's franchise, and that's good for as long as I hold it. I can have that McDonald's open for 100 years, right? Goodwill. So this is the first time we're introducing this. It doesn't make usual sense right away, and I understand we're only touching on this, but here's what it is. If you go out and buy another company, and you're going to look at all the stuff that they have, all the assets that this other company has, their net assets, so assets less their liabilities. You're going to write everything up to the market value. So you're going to get rid of historical costs, write everything up to the market value. If you're paying more than the costs of those net assets, so you're paying an excess, accounting rules say that that excess is called goodwill. It's an asset, like you're buying something about that company that you're willing to pay more than the assets are worth. Maybe because they have some really unique contracts and relationships with people and other businesses, right? This goodwill is only recorded when the company buys another company. It never gets created. So if you see goodwill on a company's balance sheet, it means they bought another company at some point. What we do with goodwill is we perform the impairment test. We don't do amortization for goodwill. We perform an impairment test. So again, this is an intangible asset. So let me give you a very basic example. This you spend way longer in intermediate and advanced accounting and other classes discussing this, but here's an example. Let's say FedEx acquires a company called Europa Company for $10 million. Europa Company has assets that when you look at the market value are $9 million, and when you look at their liabilities and you look at the market value of their liabilities, it's $2 million, right, in liabilities. So the net assets minus liabilities, are $7 million, and FedEx paid $10 million for this $7 million of assets. So in accounting, we say that this extra $3 million is goodwill. So they paid an extra $3 million over what the net assets are worth because there's something special about Europa Company. Maybe they have some special relationship in Europe that FedEx paid extra for, but it's not reflected in their books. And so how would you do the journal entry for this goodwill? Well, so you're going to take all the assets, right, at market value. This is key, at market value. So not at historical cost, but at market value. You're going to debit, that's the $9 million. You're going to take all the liabilities at market value. You're going to credit for $2 million. Okay. You're going to pay cash of $10 million. So what's the difference? The difference is the goodwill that gets created. So take a moment, take a look at this one and this previous slide and work through this to let it sink in. What about research and development costs, or R&D? These are huge, especially in the San Francisco Bay Area, where a lot of companies focus on research and development, right? So these are costs that are incurred to develop and create new products. Oftentimes, this is the most valuable activity for companies, right? If they can come up with something new, there could be huge advantages. So in the US, we do not report these R&D costs as assets. We do not capitalize them on balance sheet. Under the US GAAP, research and development costs must be classified as expenses on the income statement as they are incurred. So let's look at the effect of an asset impairment on the financial statements. So an impairment, both tangible and intangible long-term assets have to be tested every year. You can have an entire career in finance and accounting doing asset impairment testing, and you can get paid pretty well over $100,000 a year for that expertise. So this occurs when the expected future cash flows fall below the asset's net book value. If we calculate that it's impaired, you adjust the carrying value downward to the fair value. So as you can see, you have net book value, carrying value, fair value, 3 different definitions of value. Let's look at an example. I know it can get confusing. So here would be a normal situation. We expect our future cash flows from the asset we have to be the largest thing, right? We own an asset because we paid $10,000 for a car because we expect to get more than $10,000 of value from that car, okay? That would be the fair value of that asset. And our net book value, our cost minus accumulated depreciation, should be the lowest, right? We're depreciating it, and that should be the lowest. When we have an impaired situation, what we find is that if we calculate the future cash flows from this asset, it's lower than what our current net book value on our balance sheet is. Therefore, we need to write it down to the fair value. So here's an example. We have an asset that has a net book value of 100. We do some math and we estimate that the future cash flow from this asset is 80. So do we have an impairment? That's question number 1. Impairment? Yes. Why? Because this 80 is less than this 100, right? So we're expecting to have a lower future cash flows than this. What do we write it down to? 80? No. We write it down to the fair market value, which in this case is 70. So again, first, the impairment test. Is the net book value greater than estimated future cash flow? Right, which it is. This is greater than this. Then yes, we have an impairment. What is our impairment loss? It's our book value. We have to write it down to our fair value. In order to do that, we have to write this asset down by 30. That's how we get from 100 down to 70. So impairment loss on long-term asset is 30. It's a loss. And we're going to write down this long-term asset by 30. So we're writing it down directly, okay, when we do this impairment testing. Let's look at the rate of return on assets. This is a fairly highly used ratio. So the return on assets is taking our net income and dividing it by average total assets, which to get average total assets is just beginning total assets plus ending total assets divided by 2. That gives us our return on assets. There's this very well-known analysis called DuPont analysis. We need a few components to do this DuPont analysis. So let's look at it. We have this return on assets that we're trying to figure out. If we look at return on assets, we can actually break this off into net profit margin ratio, which is net income over net sales, and total asset turnover. So basically, for every dollar of stuff that we sell, how much money do we get to keep? What is our net profit from that dollar? And how efficient are we with our asset use? So that's net sales over our average total assets. Here's a thing to think about this, just to not make it super complicated in your brain. If I'm an Uber driver or I'm going to do a business as a taxi company business and my net sales are 100, would I rather do that with one taxi or 10 taxis? Which business would you rather own? Obviously, the one that can do it with one taxi, right? A more efficient use of assets. So DuPont analysis takes return on assets and breaks it up into these components, the net profit margin and the total asset turnover. If you take these components, you can see when you multiply these fractions, net sales cancels out, and so you get the return on assets, net income over average total assets, which is what we showed here. So that's what DuPont analysis lets us do. It lets us figure out, okay, you have this return on assets. Why is it high or low? Is it because your net profit margin is high or low? Or is it because you don't use your assets very efficiently? Or you use them very efficiently? So here's an example of FedEx's return on assets if we use this analysis. So I'm just going to do 2015, and then you can follow along and do your calculation for 2016. So I can calculate FedEx's return on assets by doing the net profit margin, right? So net income over net sales, how much did they keep from net sales, and total asset turnover, the net sales over average total assets. And that tells me what my return on assets is 3%. You can do that for 2016 too. So finally, in the last section, what is the cash flow impact of long-lived asset transactions? What happens to our statement of cash flows? Well, if we acquire property, plant, and equipment, this is an investing activity. We're investing in our company, okay? So this is going to be an investing activity. If we acquire, cash goes down. If we sell an asset, it's also an investing activity, right? Cash goes up. If we depreciate an asset, right, or amortization, this is part of our operating activities section. All of this is going to make a lot more sense once we get into statement of cash flows, but this is just a good touching base. So if you look at the statement of cash flows, we have 3 sections: cash from operating, cash from investing, cash from financing. And you can see long-lived assets create depreciation and amortization, and that shows up here, cash from operating activities, and we're adding this back, this expense, we're adding it back because it was a non-cash expense. Again, it'll make more sense once we get to the statement of cash flows. And then for investing activities, if we buy capital assets, cash goes out, right? And in this case, we have other asset acquisitions and dispositions, the net. So they net all the money coming in and out, all the cash going in and out, and the net is this company spent about I presume this is in millions, so probably around $9 billion acquiring stuff, which makes sense. FedEx probably buys a lot of airplanes and trucks and everything else. Finally, we have this section of cash flow from financing activities. This is not affected yet by property, plant, and equipment. It is, but indirectly, when we need to raise money by issuing debt or stock. So that's it. This is a big chapter, a lot to learn. You'll probably want to watch this lecture at least once, maybe twice. We'll work some problems in class, but definitely this can be a challenging chapter, so come prepared with lots of questions.